Hi, I'm Sam Sells, and welcome to my podcast, Clean Money. I like to say investing matters, and my show is to talk with everyday folks that are not only creating great success, but making an impact in society and improving the lives of others. That is my mission, and I want to share my stories and others with you. Welcome to Clean Money. Thank you, everyone, for joining with us today for another great episode of Clean Money, where we talk about making a difference in the world by how we invest our time and our resources. Today, I'm really excited to talk to Mike and Ligia, who have done something that I've recommended to a lot of people over the past few years, and that is to check out Think Multifamily. And they are both Think Multifamily, I don't know, alumni is the right word, but active players working in that system. Mark and Tamil are fantastic. They have a great system set up. And we'll talk about that a little bit about your journey. But what's super cool is, like Mike, you were saying, I used to be a 401k guy. Hey, get a job, kid, kind of, life that we all grew up in, at least we did. That's old gray hairs. And then, you went from that into leaving corporate America 7 years ago, where you worked, 8 to 5 plus everything they wanted you to do. You had to ask for time off. But now you guys do syndications. You're in real estate. You're buying raw land. And you've gained what I say is the point of choice, or the point of freedom in life, where your passive income overtakes your expenses. And now you can do what you want with your time. You can live where you want. You can use your time as you want, and you're free, right? You're free to choose. And so that point has happened for you guys. You made it happen. You've been doing this for 7 years. You help other people do that, and you changed your lives dramatically. So please, thank you for joining the show, and love to hear more about this journey that you guys went on from the humdrum life that we've all been through to where you guys are today.
Yeah, thanks for having us on the show, Sam. We love to talk about our journey and hopefully inspire others to some form of action should they want it. But yeah, I mean, like I was saying, I think we both kind of started out a similar path, although Ligia's from Romania. She grew up under a communist dictator for, the first 14 years of her life. And so that was vastly different upbringings there. But, we were both went to school and got a job after school. And then just, that was framed as what I was supposed to do when I grew up, right? You go get your good grades, you go to university, you get out, you get a job, you climb the corporate ladder, you feed your 401k, and ideally you retire with a nest egg and you sail away on a sailboat and do all the things that they show on these mutual funds.
And don't bother the younger generation, right? Because
that's right. To go on about your business.
Yeah, go about your business.
But yeah, so like you said, in 2016, we were almost forced with a decision. We both found ourselves out of work at about the same time. And so because we were working W-2 jobs, our income stopped. Like, we didn't have a side hustle. We didn't have any type of cash flowing investments or anything like that. And so, we fortunately had some money in the bank, but it was a stressful time of crap. We got to, restart the money machine, pay for the big mortgage that we had and the cars, and two older daughters that were entering the college life themselves. And so, the immediate response, the knee-jerk response was, okay, freshen up the resume, get out there, work the network, start going on interviews, all the stuff that went along with that. And, I personally, I had a few quick interviews. I worked in larger tech companies. And so I had interviews with other larger tech companies. But I really had just a gnawing sensation or a sick feeling in my stomach beyond just the anxiety of going on interviews. It was really like, what kind of company culture am I stepping into?
Right.
at that moment, I was doing a lot of business travel. Am I going to have to do that again? Are we going to have to relocate to the West Coast or to, some other place, corporate headquarters? And just all of that was churning inside. And we decided to kind of take a moment, step back and think about, okay, we have a choice that we can make in this moment. Is this the path that we want to step back into, or is there an alternative? And fortunately, Ligia's super supportive, and actually, because of her upbringing, comes from a different mindset than I did, where I'm a lot more safety conscious in terms of finances and, what if I make a misstep and do something wrong or whatever? But we did take that moment and we thought about, okay, what if we do something different? And what if it fails? Like, what's the worst thing that happens, right? Okay, well, we either try something else or we get a job, or, life will be okay. And the early part of my adult life was saddled with mortgages and kids and this American dream where we just keep consuming and growing and amassing debt. And that does trap you into a certain mindset, or it can anyway, trap you into an inability to take risks. And that, I already kind of came from that lifestyle, but, in that moment we were able to take that and we had a few ideas. I think we had revisited Kiyosaki's Rich Dad, Poor Dad, and this seed of cash flow and getting into the entrepreneurial side of the quadrant and doing those things that do liberate was already there in the back of the mind. And so we took that moment and said, let's give it a go. Let's do it. And we did. And, we can get into the nuts and bolts of that, but fast forward, as you mentioned, we just last year bought a house in the mountains where it was our preferred place to live. And we're just able to spend our days in nature and kind of we'll go next month to visit Ligia's family. We'll spend the month in Europe, and we don't have to worry about putting in paid time off requests, or is the money still going to be coming in, or those, those kind of things. And so it's just amazing. I mean, I never discount what got me here. And so I don't look back with regret and say, oh, I spent all those years in corporate America. I mean, all that served me. And that moment in time really, I think, was our moment in time to be able to take those risks with less risk.
And I think in 2016, we both realized when our offices closed, we were living in Dallas, Texas area, and both our offices closed. And if you wanted to keep a job, we had to relocate. And Mike would have to relocate in Seattle, and I would have to relocate in Fort Smith, Arkansas, which we wouldn't do. But we realized that job security is kind of an illusion. You can actually go job hopping or try to seek other jobs, but really job security was an illusion, and we wanted to do something different for our lives.
Excellent point.
Yeah, I love that. My father-in-law is as about anti-investment as you could ever get. Retired as a chief in the Air Force, back as a government civilian, worked another 20 years. But his wife, my wife's mom, has had a significant medical event that happens to people when you're in your late 60s or any time in life. And now he can't work. And so he's retiring earlier than he wanted to, and he's losing about $60,000 or $70,000 a year in 2 months, in 3 months. And so all of this, investment's terrible, just work and blah, 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 blah. And now all of a sudden it's gone. Right. And fortunately he has retirement and so forth, but it's just like, I hear this all the time, and I've, growing up, I hear it all the time. Oh, you need a good job and, guaranteed work and everything else. And I think the past 20 years have shown that there is no security. There is no retirement. You need to do something different. And there's enough real estate in America that every single person in America could be doing something to earn passive income. It's not like you can't go out and find it. It's not like you have to have $10 million in the bank to go buy something. And so you guys took the leap, you took the jump, and you said you were really stressed, Mike, about making mistakes. Ligia, not so much. You're like, no, I know nothing's for granted in this world. We got to make our way or else we're toast. So tell me a little bit about some of those mistakes that you both made when you took that jump, and over the past 7 years, what have been some of your biggest mistakes, things that you would, you learned the most from perhaps, but that really made you think, I still want to do this despite this thing that's happened?
Yeah, really, really great question to reflect on. Like I mentioned a minute ago, I'm not a, it's interesting. I have this fear of failure and this fear of making mistakes, partially just in the core of who I am, right? I was a first child. I was pushed to, get the good grades, make straight A's, excel at sports, and I can kind of look back and say with grades, yes, my parents did push me really, really hard, but they never really put any expectations on me beyond that. I had a lot of this just own internally, and maybe some of it was subconscious or whatever. But at the same time, I can sit here and tell you, I'm not a person who looks back and sees things as mistakes, right? That's all about learning and growth. And like I mentioned earlier, everything that has happened to me has served me to bring me to this point in which I am supremely happy. And so it's kind of this weird conflict of things. But, I would say just starting out for us, we did a lot of things right. We set aside some seed capital to get started. We gave ourselves not really an explicit time frame, but we did have a time frame in mind that said, we're going to give this a go for a certain amount of time. We knew that this was what we wanted to be our full-time adventure. And so we found a coach and a mentor to help us and to get us started and to help prevent us from making mistakes that had been made before. And so we did a lot of things right. I would say, we've talked about this. If we look back and reflect on things that we maybe would have done different, we would have gone in faster. Like we were very timid about, so we started in vacant land investing, which is essentially flipping. It's just buying land cheaply and flipping it for a profit.
Yeah.
And a lot of what we do in that business is owner financing. And so in that way, we build up this cash flow stream. Well, when we started out, we were super picky. Like we would look at a property that somebody was willing to sell and we'd be like, oh, it's got a little slope to it, or it has a crack, or it's not very pretty, or we were projecting in the minds of future buyers that nobody's going to like this. We have since, we buy anything we can get our hands on because there's somebody that's going to buy that property. You just have to find them, and we have never been stuck with a property. So anyway, we would have gone a little bit faster. Yes. However, we went at our pace and we got to where we got to, and so that's. That's one thing that we look back on the land side. On the multifamily side, we've been in for a few years now, syndicating in apartments, larger 100 unit plus. You mentioned, I think multifamily. We joined with Mark and Tamil. Same thing. When we decided, and we got into multifamily largely because we wanted to diversify, but also we had built ourselves a tax problem because we were making too much money. And so we were
flipping is like it's a tax monster, right?
It's great. And so, in that journey, one of our, I won't say it's a mistake, but it's certainly a lesson. And I think it's a very applicable lesson for a lot of people listening is, in the world of syndications and really any investment in general, and this is what's actually so great about real estate, it is so important to know who is running your investment, who's operating the deal. A business plan can be lights out great, but if you don't have the right people championing and leading the deal, it can go sideways so easily. And so, our early days, we were eager to get into deals, and we really didn't spend a whole lot of time vetting the people that were running the deal. And partially that's because a lot of us we were in a like-minded group, and we had this false impression that everybody in the group was a great character, all this stuff. Well, you don't necessarily know that, and it's hard to really know that.
Just because they're nice doesn't mean they have good character.
Exactly.
I learned that on the hard way too. Yeah. Super
So
nice.
that's one of
Take
our
out dinner, yeah, but
exactly,
Right.
yeah. So that's one of our biggest takeaways in kind of multifamily and just real estate investing in general is we do take a lot of time, and I won't invest in a deal unless I've really vetted someone. And within the world of syndication, sometimes these come up very quickly. I have people reach out, hey, we're working on a deal, we're looking to close in 30 days or whatever. It's just not enough time for me. It's like, okay, well, that's great, I'll catch you on the next one maybe, but if you want to form a partnership, let's take some time to explore each other's track records, get to know a little bit more about the character. How do you operate a deal? Are you communicative? Some people lean into problems, some people run away from problems, and it's kind of it's super important to know those things. And I think a lot of investors, especially in the world of what I've seen in syndications, you get these glossy marketing decks and look at these business plans and everything looks rosy and these returns are going to be great. But, you don't get a lot of insight into the people that are running the deals. And so that is, I would say that's our number one criteria, as much as we can vet that out before we'll go into deals. But yeah, I mean, those are probably our two biggest takeaways from, one from land, one from multifamily. And it's things we definitely have learned from.
I love those comments because we've done about 22 deals now, in most of those have been syndications. We've had a few that were just joint ventures or an institutional deal where we worked with an institutional partner. Over time, I've learned, a lot of lessons, but, three resounding things is one, the partner themselves. You're going to have problems at that property. You're going to have problems with the market if you're going to be around longer than 2 or 3 years in anything. There's going to be something that's going to happen in the market, right? And I'm seeing, and then the third is the debt. You can have super glossy, awesome deck. You can have folks who went to Wharton and partner, they have all the fanciest people on their deck you've ever seen. None of them, of course, are doing anything with that deal. But they're off doing their own thing. And then, they raise a lot of cash and they put it all in there, but the debt's terrible, or it's not very good, or, you just don't know, because they can raise a lot of money, but it doesn't mean they can run an investment. And so we're seeing a lot all over America right now. It's all in the news, but it's not in the news that people read on CNN and these others who are primarily focused on clickbait, Fox, CNN, all those. I wrap them all up in the same. It's all clickbait news, right? And nobody cares. But there's tons and tons of operators walking away from giant deals because they don't know what to do, and the debt's gone up so expensive, and they're walking away and just letting the banks take it. And it's big folks like Blackstone and all these other big ones, and it's small guys too, because they're not leaning in, or they're too embarrassed to share their mistakes with all their partners. So there's just,
and some of those larger operators, it is a business, and they just know, maybe it's too much effort and their capital's better spent redeployed other places than trying to save a deal or other things. Yeah, it's definitely and so the last 2 years, anybody who was running a syndication is a hero, right? I mean, the market has just been on fire. We were buying properties from people that had held their properties for less than 12 months or less than 24 months, and they had already pretty much made their business plan. And it wasn't because, and there was still, we do a lot of value add, as it seems like you're involved as well. And so, those deals hadn't done any value. They just had held on for the market gains and sold out, which is great. I mean, they rode the market at an awesome time. Investors made a bundle, but now you start to see who are the operators and who are not the operators, right? Deals. And so, they're getting pressure from increasing interest rates and increasing material costs and labor costs. And maybe some markets aren't 98% occupied across the market and things like that. And so you definitely start to see who is savvy and who knows how to navigate choppy waters and who are bailing out in those ways. And it is an interesting time period to run, as it is, right? Like you mentioned, if you're in this for any length of time, the conditions change, right? It's just the nature of the market. And that's where good partners, and I consider lenders as part of the partnership. I mean, I'm aware we've invested in a few deals where there was a lot of lenders in the landscape over the past few years just because there was so much deal flow. And so a lot of those lenders are also in trouble, and they are getting out, right? We were in a deal where the lender said, I'm sorry, but I need you guys to refinance or sell in the next, number of months because they needed out. They needed the cash flow. And so, our team of general partners had to scramble to kind of figure out how to get that deal refinanced. And, there's a few like that. Some of the bigger institutional lenders are obviously much more stable and know what they're doing. But you can definitely get into some bad debt.
Definitely get into some bad debt or bad partnerships. Or I have seen, because of all this, I think, and I don't know if you guys have seen this too, but the SEC says if you're going to raise money for somebody else's deal, you need to be involved in that deal. You can't just raise money, get paid, and run off into the sunset. And
right.
We've seen some of our, I think it probably happens to every syndicator. You bring somebody on new, they talk a big game, they bring capital to the deal, they run off, you ask them for help, and they're like, no, I already did my part. And you're like,
yeah.
Okay. So.
Yeah, we see that too. I mean, it's unfortunate part of the business, and we'll see if that changes here over the next. I know there's discussions floating about the SEC if they open that up to allow a little more transparency, let's call it, in the equity raising, because there are people that do want to do just that. But yes, I mean, it's intended to be a partnership with everybody, chipping in their way, whatever that is, through, liquidity or through communications or management skills or help. And I mean, we operate several deals, and I host monthly partnership meetings, and there's usually only a handful of people that show up on those. And that's okay. I mean, not everybody can show up to every meeting. I get that, but it's, routinely a few people that are genuinely interested and willing to help. And then the others are on to the next deal.
Yep. And those are the ones you don't invite back, because those are the ones who get you in trouble, or they get, unfortunately, been doing this long enough to have a few investors will say, well, so-and-so never told me that. I'm like, I mean,
but anyway, there's pitfalls, and not to scare anybody away from the investment. It's just kind of come in with eyes wide open and make sure you are, as best you can get track records from people. You can talk to people who have invested in other people's deals and understand what kind of communicator are they, or, are they transparent? Is it regular? I'm always surprised, I guess, because my communication style is very open and regular. And I come to this from the corporate world a little bit, but I am surprised when I hear about people that are in deals and to your point, they say, well, we didn't even really get any communication, or the financials weren't shared with us, or, other things like that. It's like, okay, well, red flag there. That's
so either there's fraud happening, or they hired a terrible accounting firm, and they're just
a little secretive. They don't want to share things. But anyway, it's things to come in and look for. But for all of those, there's probably 10 great operators and people that run properties out there, and we know a lot of them, and there are a lot of best practices that are widely practiced out there. So it's I mean, I'm looking forward to continue. I think there's going to be great deals ahead. It's fueling our lifestyle today. And to your point, I mean, it's really, for us, it's not so much about having a sizable nest egg at a certain date in time. It's really about building a cash flowing engine that will last beyond us, that kind of we can hand to our children and those who we want to pass along wealth and businesses and investments and things like that. It's certainly opened our eyes to a different paradigm in how we're going to spend the latter half of our year, of our life. Sorry.
That's fantastic. So you hit on something that I think modern society is slowly coming around to, is this idea of cash flow is more important than net worth. and or assets under management or these other figures that we like to brag about. Because at the end of the day, your house is paid through cash flow, unless you paid it all off with cash, which was still that cash came from somewhere, right? Having equity, you can have $100 million in equity, but be in a spot where you can't buy a sandwich because you don't have any cash, right? And that happens. It has happened to a lot of folks. And I think about, our ups and downs in the company's history, the cash flow and the, how much we're worth or so forth don't always line up, right? Because you can have equity in a deal, but it's not giving you any money. Mm-hmm. So when did you, in your journey, when did that cash flow finally get to the point where you had the point of freedom, and at what point did you, and then why did you decide to go into syndications? Was that the same time? Was that before? And tell me just kind of that differentiation, if you could.
Yeah. So we got into land initially, really for the cash flow. And as I mentioned, the way we went about it, because of that, like there's different ways to buy and sell land, but the way we went into it was really in owner financing to build up a longer term cash flow. And so, when we sell a property to someone, let's just say it's similar to a car. We'll be the bank. We'll finance you for your $30,000 purchase. Pay us $350 a month over the next 5, 6, 7 years. And it was amazing. And so, it wasn't an overnight success. And we obviously had some investment up front, and it takes a while to recoup some of that investment because somebody's paying smaller chunks back on your investment. But I would say we started right at the beginning of 2017. So we spent 2016 doing a little research, some education, learning, setting up our business, and then we kind of came out of the gates. And it took us longer than most, I think, at least the people that we knew that were doing this. It took us about 6 months before we went the cycle. So we bought some inventory, and really what took us a bit of time was just getting that first sale. And we just had to find the formula that worked. And, once we did that, things really accelerated very quickly from there. So I would say for us, our first hurdle was get into the black. So stop dipping into savings every month to pay our bills. At the same time, we also made a conscious choice to downsize, right? We had a large house in Dallas, a certain lifestyle. And we decided we were at a place where we didn't need that lifestyle anymore. And so we sold our place. We moved to Colorado. We started renting a townhome until we could figure out where we wanted to live exactly within Colorado. And so we made an active choice to, I'll say downsize. I don't know, from a Bills perspective, maybe we didn't save all that much because we moved from Dallas to the Boulder area, but we made this effort to live a different lifestyle. And so, it probably took us about 12 months before we nudged where our income was paying our bills. And then our next, we just started setting goals over and above that. Okay, well, let's get to the next level. And things have just accelerated very quickly. And so we probably spent 2.5 or 3 years in the land business, just building cash flow, and it was great. And then, as I mentioned, what really nudged us was looking for tax incentives, as well as a desire really to diversify. We had all our eggs in the land business, and we just started thinking, okay, there's some risk here, and so let's diversify. And at the same time, take all the advantages in commercial real estate that you get. We're real estate professionals, so we're full-time in real estate. And so we can take even more depreciation and offset our gains. And so we started looking at what are the options. And really it came down to storage versus multifamily. And it was hard from a financial standpoint to see a clear, better asset class to start with. We liked the idea of value add multifamily just because it does give back to the community, and you're helping the lifestyles of a lot of people because you're investing in their community and helping improve rundown buildings and those kind of things. And so we saw that as a little better way we wanted to invest some of our time and money. And so we just started in multifamily, and we as with the land business and starting our road to entrepreneurship, like I said, we went about it in the same thought process. We said, okay, we want to be successful in this. There are people who have been down this road before. Let's find a coach and a mentor to help us. Whereas we may spend $5,000 to $10,000 on a piece of land that we buy, well, you're spending $5 to $10 to $20 million on a commercial asset. And so, the impact of a misstep in that world is just much more severe. And so, we really wanted someone with deep experience and that could help coach us and partner with us, quite frankly, on deals. And so we went through about 6 months of researching the different groups out there. We found our way into Mark and Tamil's group, Think Multifamily, and it just felt completely different than the others that we'd been looking at. It was very small and intimate. We spoke with several people that were in the group, which was unlike the other groups, which are a little more protective about, we don't really want you speaking to active members, which, comes with its own set of flags. And so anyway, we decided to mentor under them, and it's been great. So we've been, they're coming up on 3 years, I think, and we followed a very methodical path, really not out of too much intention, but just, we joined a couple of deals as LPs. So we passively invested just to get a feel for what is this investment all about. It gave us a certain insight into what it takes to run a deal. And then we were able to leverage that experience into becoming general partners, which gave us another level of insight into what it takes to be in the partnership, to our earlier conversation about taking an active role and really helping. Into, most recently, we've led our most recent deals as lead sponsors. And that's an even, another level of detail and going through the full end-to-end process of, vetting a property, putting in a letter of intent, finding the debt partner to work with, and then all that comes along with operating a deal after that. And so now we're at a point this year where we're starting to reflect a little more on, how exactly, knowing all of this, what role or roles do we want to continue to play in this? Is it to continue down the full acquisitions? Is it to contribute, in other ways? Because there is a heavy time aspect of things when you're actually running a deal. Asset managing and operating and even the acquisitions piece is a significant time investment, which, I enjoy doing personally. But I don't know for how much longer. We like to be outside and we like to go on trips and we like all this other stuff. And so, there are other ways to generate cash flow that aren't as active. And so we'll figure that out going forward. But, for now, it's been a great journey. And, for anybody out there, like we kind of took this burn the boats approach almost by force, right? We were out of a job and we just took the leap full time into real estate. We talk to people all the time about this, and it's, a much more logical step while you have a job or some other source of income to just start passively investing in real estate and getting all the benefits without investing the time and the effort and all of those things that go into it. And so it's, definitely I would say probably a much easier path because, as long as you're doing your upfront vetting and looking at your deals and you have that, financial capability to invest in deals, and that that's the way to go. If, on the other hand, you maybe don't have as much money, it's a great way to utilize sweat equity to get in and do this stuff. And you can invest in a lot of these, your time, and get financial benefits and equity and net worth and all that comes along with it. So for all those reasons, real estate is amazing way to invest your time and generate cash flow and equity and net worth and all of that. So
Yeah, I love it. You said so many great things in there. You talked about coaching. That was a phenomenal choice by you two to decide to go with a coach, find the right coach at the very beginning that fit what you were looking for. I did not find a coach. If I could go back 5 years in time, I'd punch myself in the face and say, Sam, go get a coach because you're going to make all these bad choices. Then you're going to have to fix them. But it's just going to consume your life as you try and fix these things and learn the hard way. Why learn the hard way when you can, like you said, you can go buy a piece of land or you can invest in your future. And it was a significant level up for you guys to go from, I mean, land is great and you're probably still buying land whenever you get that stuff. But, the difference in the trajectory is significantly changed through syndication.
Oh yeah,
Yes.
for sure. I mean, yeah, for us, so land is still a cash cow for us. We love it. We actively run it. We actually just recently started coaching others in how to start up their own land business and generate the same level of cash flow.
Yeah.
I will say it is difficult to deploy large amounts of capital, at least the way we run the business. We do a little more residential, smaller parcels. The speed with which we can make those transactions is much quicker than larger development projects where you're buying larger tracts. Maybe you're subdividing them, you're adding some value into those. And, that's certainly a way to get larger amounts of money. It's a little more time consuming, and the yield, I mean, our return on investment in the land business is 150% annual return on our investment. And it's just incredible.
Yeah.
And so it's a great way to do it. It's just hard to deploy six figures into, until you build up a machine. And then once you have more of a business, you can scale things over time and it can be done. But when you're starting out, it's certainly not like you can just go find a great syndication and invest $100,000 and start earning your returns after that. But
yeah.
And if I may add, we found it really important to have a diversified portfolio. I remember we joined multifamily group in 2020, and that was the year when COVID hit. Mm-hmm. And we really thought in the beginning of the year that our land business is gonna shrink to nothing, because when there's troubles in the market and when a pandemic hits, like who wants to have a recreational property to go out there and camp and hunt and but it was the opposite. Actually, our sales went to the roof. But also I think when you have a diversified portfolio and you invest in different assets, then you can prevent those market changes and the hit that you can get from all these changes that come on the market.
Exactly.
Yeah, I love that. That's great. Diversification is so essential because you can lose all your money. Just like you said, you can lose a lot. There's big folks who are losing tens of millions or hundreds of millions of dollars of investor cash right now. So if you're an investor in one of those deals, your money just went poof because, like you said earlier, Mike, that entity is saying, it's not worth our time and effort to try and save these deals. We're just going to give them back to the bank and move on. Sorry, investors.
Cut our losses.
Yeah, cut our losses and move on. And so there's risk in the big guys. There's risk in the little guys. There's just risk in the market. And so having that diversification is really, really important. But a 401k is not diversification in my idea. It's just
yeah. I mean, that in and of itself, I don't know. As I've been on this journey, I mean, I had a 401k when we left the corporate world. We rolled that into a different 401k where, it was a little more flexible in terms of what we could invest in, but it was still stocks and funds. Mm-hmm. And then once we got into real estate, we went into self-directed. Yeah. And just, it was a little more, we started a business. And so we were able to roll it into a business 401k plan. but there are other ways to do it as an individual. And we work with several people when we have these investments that want to invest in real estate, right? There's a way to take some or all of your money out of that 401k into something that's a more flexible product. That's a lot more transparent, right? The fees that are involved versus when you're investing in 401ks and funds. I mean, there's so many hidden fees stacked throughout the process. I see, like, my mom and dad, they had my mom, similar to your parents, I mean, or your in-laws. Like, my mother was a teacher, and so she gets a state pension, and similar thing. She left the workforce a little bit earlier than she wanted to, so she didn't quite get the full pension. But it was enough. Well, now life conditions have changed such that it's becoming not enough, right? She had some unexpected expenses that are coming up, and inflation goes up more than your pension, which hers is fixed, and so there's all these things. But I guess where I was going with that is they also had some retirement accounts that had mutual funds in them, and I would hear every quarter they get their statement and they're like, I lost, it's less than it was the quarter before, or even though the basket of funds is going up, the fees are eating into the margin, and so it's just it's really
and if you touch it, you get like a ginormous check
penalties
to send to the government. I mean, it's just
it's sad. It's sad that's that's what is fed to us as the normal way, and it's they make it so easy, and it's a great thing that when you're in a company, that there's a company sponsored plan, there's company matching. I understand that it's in their interest to go with a Fidelity or somebody that has it all, it's plug and play, and they can do all this. And so all those things are great, but I think the fallacy in it all is that that's what's normalized, and that's what's put in front of people as essentially kind of your only option in doing these things. And so, I'm a person that really likes, I love finances and investing. And even when I was in my 20s, I was looking into, the internet was just kind of coming into vogue, and there were all these different companies, and you may be familiar with like the Motley Fool, but they're, investing education platform. And so in the world of stocks and bonds, I was always a fan of doing research and understanding, and you did get exposed to the fact that there are fees, and that maybe index funds are a great way to go and do those kind of things. But it was again a very narrow slice of what was possible in the world out there, and it was through I don't know if you call him a pioneer, but these great pioneers like Robert Kiyosaki, who's out there preaching that there are other ways to go about generating cash flow, and you don't have to follow this mold of get a paycheck, pay into all the social taxes, and cross your fingers that when you get to be 55 or 65 or whatever the age continues to go up to retirement age, that you have enough to coast through the rest of however long our extending lifespans get to be, and all of that. So
lost a lot of money following the Motley Fool's advice a long time ago.
Yeah. For some reason, they generate amazing returns with their picks, but I'm also not. I wasn't ever able to invest in the 45 stocks that they were investing in. Right? It's like
it never worked. So. Thank you both for joining the show. We've talked now for a while, and I love your story. What's amazing, it's not what you guys have done is not like other people can do the same thing, right? They can do the same thing. You don't need to be a rocket scientist. You don't need to have, graduated from, whatever, pick your favorite university. But you can do it. You can make a difference, but pick a coach, get on the path, dig into it, like you said, lean into it. And Ligia, like you were saying before, be willing to try those things, even though it may be just a little bit risky, and stick to it. And I really appreciate your feedback. I love what you guys are doing with your money. I love value add. It's a clean way to invest and make a difference in the world. And by doing land the way you do it, you make it more accessible because your owner financing it is great for you. It's great for the buyer, who probably couldn't get the cash to put down on the property anyway. So it works out, right? We can do a lot of different things. So please, for those folks who want to find you, how do they find you? How can they reach out?
So Deaton Equity Partners is our commercial side of the business. We have a landing page, Deaton Equity Partners /freedom, where we try to make it a one-stop shop. So if you want to get in touch with us, we have contact information. If you're interested in learning more about multifamily investing, you can find some information there. If you want to leap over to land investing and hear a little bit about what that is, there's also an offshoot point there. We also just started a coaching program. Flippingdirt.us is the landing page for that. And so you can learn all about what that entails. If you're interested, sign up for our coaching program. It's a great way to get started generating easy cash flow. But yeah, those are probably the best couple points. We love chatting with people about, transitioning into something different. And so please do reach out if you're interested at all.
Yeah. All right. Thank you. We'll make sure that's in the show notes. I have checked out your website, flippingdirt.us. I love that tagline. Flip dirt and get filthy rich. Awesome. Love it. All right. Well, thanks to the both of you for sharing and spending time with myself and our audience, and have just a wonderful day. Thank you so much. And I look forward to speaking with you again.
You too, Sam.
Thank you for having us.
Thank you for tuning in to Clean Money, where we talk about sustainable investing that improves society. We are passionate about creating great investment returns to investors who want to use their money to make a positive social impact in the world. If you enjoyed the episode, we'd appreciate a 5-star review. And if you are interested in making your investing matter, please connect with us at wildmountaincapital.com, or you can find me, Samuel Sells, on LinkedIn, on Twitter at Sells_Samuel, on Instagram at Clean Money Sam, or on Facebook. And finally, make your investing matter.